Hello and welcome to the Morning Filter podcast. I'm Susan Dziubinski with Morningstar. Every Monday before market open, I sit down with Morningstar Chief U.S. Market Strategist Dave Sekera to talk about what investors should have on their radars for the week, some new Morningstar research, and a few stock ideas. So today on the Morning Filter, we are celebrating our 3-year anniversary of the podcast. So on today's episode, we'll be taking a look back at Dave's very first stock picks from our first show to see how they've done since then and find out whether any of them are still attractive today. And we're also welcoming a special guest to talk about the Fed in 2026. And we'll, of course, preview the earnings of some big companies reporting this week. All right, Dave, good morning and happy anniversary to you.
It's amazing just how quickly time flies. I can't believe we've been doing this for 3 years already.
I know. It's quite something. So, and we want to thank our audience for being along with us for the ride. And of course, our video producer, Scott Halver, who's also been with us for 3 years on Monday morning. So we appreciate him as well. All right. So, Dave, a couple of weeks ago on the podcast, you said that you expected 2026 to be even more volatile than 2025. And that sure was the case this past week. Stocks fell 2% on Tuesday and then revived, finishing the week down just a little bit. So was the volatility we saw last week all about Greenland and tariff threats, or what other factors might have been in play?
Well, actually, before we get into that, I also just want to call out Miami University's college basketball team. Waiting to see the college rankings come out this morning, but hopefully they're still going to be in the top 25, which I think, as you and I were talking about, that might be the first time they've been in there since 1999, and certainly hoping for a good season, like maybe going back into the 80s. I believe that's when they had Ron Harper on the team. So again, we'll be watching closely here, at least at the Morning Filter. But yeah, as far as market volatility, I think this is just going to be a very volatile year. And I think investors are going to have to get used to this kind of volatility, not just, once or twice, but over the course of the full year. Now, of course, with President Trump in the White House, there's just never a dull day. Yes, we had a lot of headlines out there about his desire to acquire Greenland and potentially new tariff threats and all that kind of stuff. But in my mind, I think that was all more noise than signal. Now, in the 2026 outlook, I did note that, trade and tariff negotiations were one of the key risks this year, but I don't think this was it. I think it's not going to be until the spring. U.S. will probably look to reevaluate the USMCA. That's the trade agreement with Canada and Mexico, and then probably have to restart the negotiations with China in the spring and the summer. Those are the catalysts I'm looking for market volatility from that. What we saw last week, I think, was different. Now, in the outlook, we also noted that we highlighted that, the potential for ongoing weakening for Japanese government bonds and the Japanese yen was a key risk for this year. Now, both have already been on a long-term weakening trend, but the risk is if that weakening were to accelerate, and that's what we saw last Tuesday. So, for example, the 10-year Japanese government bonds hit 2.35%. Comparatively, they were only 1% a year ago. Now, those bonds have a duration of over 9. So what that means is that for every 100 basis point change in yield, you can get an increase or decrease in the price of those bonds by about 9%. Now, on the longest end of the curve, the 40-year Japanese government bond, that hit 4.25%. Those bonds on Tuesday widened out 23 basis points just that one day. That's 175 basis points wider than where those bonds were a year ago. Because those bonds have such a long maturity, they also have a very high duration. The duration here is about 22. So essentially that means for every 100 basis point change in the yield of those bonds, that's about a 22% gain or loss. So last Tuesday, based on that yield movement, that's a 5% loss in just one day. Now, to put this overall in context, globally, the amount of Japanese government bonds outstanding is $8.4 trillion in US dollar terms. So any movements there really have some outsized impacts, globally, overall. Now, we did see a rebound in those Japanese government bonds on Wednesday, and they've actually been strengthening ever since. And we see even more strengthening this morning. So the real question, I think, for investors are, is this real buying, by investors out there, or is this probably more likely just Bank of Japan interventions? In my mind, I think it's just the Bank of Japan interventions for now.
So, Dave, talk a little bit about how important this factor of the performance of the Japanese government bonds is really for U.S. investors. Is this something that, we should be having on our radars?
I mean, I'm certainly keeping it on my radar, and there's really two systemic risks that could occur here. If Japan and the Bank of Japan lose control, of those bonds and the prices. So the first would be the potential for the carry trade to unwind. So people may not know what the carry trade is, but essentially a lot of hedge funds would borrow in yen because the interest rates were so low, and then be able to reinvest those proceeds in foreign denominated assets. So if it's no longer cheaper than to borrow in yen, they may look to unwind that trades, which means they're going to be selling those foreign denominated assets in order to repay the Japanese denominated debt. The other one would be solvency. And so I think the concern here could be the solvency of Japanese insurance companies and banks. Of course, the decrease in bond prices would then lead to lower capital levels at the banks, could then lead to concerns about credit counterparty risk. To some degree, it could be similar to what happened in March 2023. That's when Silicon Valley Bank, went insolvent because U.S. interest rates, rose very quickly. They had a lot of long duration assets on their balance sheet. So even though they were in hold to maturity accounts and didn't actually have to recognize those losses, everybody knew that there were big holes, in their balance sheet. Also, if it's not a solvency issue, I think it just reduces the ability of the Japanese banks to be able to lend, which would then also impair the Japanese economy. So as I think if they're still like the third or fourth largest economy in the world, certainly could have some global repercussions just from that alone.
All right. So Japan, keep an eye on those bonds.
Mm-hmm.
Let's bring it back here to the U.S. We have the Federal Reserve meeting for the first time in 2026 this week. Looks like the Fed's preferred inflation measure, the PCE, came in as expected last week. So then, Dave, given all that, what's the market pricing in as the probability of a rate cut at this week's meeting? And then what's the market expecting through May?
Well, as you know, the PCE was really essentially a non-event. It was just showing inflation, not necessarily getting any better, but also not necessarily getting any worse. And in fact, considering how much the AI build-out boom has bolstered economic growth over the past couple of quarters, I think that was actually probably a pretty good print for inflation. To put that in perspective, GDP came in at 4.4% for the third quarter. The Atlanta Fed GDP now is running at a 5.4% run rate for the fourth quarter. So I think I actually would have expected inflation to be higher when we see those kind of growth numbers in the economy. As far as what the Fed's going to do, I mean, essentially it's a 0% probability of a cut this week. It rises to only a 15% probability of a cut in March, 30% probability in April. So it's not until June that we get above a 50-50 chance. The market's currently pricing in a 60% probability right now. And I'm still holding to my opinion that I've actually had for quite a while. Unless there's some sort of exogenous shock to markets, the markets, crater. I don't think that they're going to do anything until the new chair takes over. That's not going to be until May. And then the first meeting thereafter is June. And I think that's why the market is then pricing in that 60% probability of a cut at that point in time.
All right. Well, we're going to talk a little bit more about the Fed in 2026 with our special guest who's joining us today, and that's Sarah Hansen. Sarah is a senior reporter with Morningstar and an occasional host of our sister podcast, Investing Insights. Sarah, thank you for joining us from snowy New York. We appreciate your time.
Thanks so much for having me. Super excited to be here.
Yeah. Now, you've done a good deal of reporting about the Fed. And for our audience members, we've included in the show notes an article that Sarah did earlier this month from Morningstar.com, talking a little bit about expectations for the Fed in 2026. And she's here to talk about some of them. So let's start out with talking about the divisions that we saw within the Fed. They really intensified in 2025 and, as you noted in your article, are pretty likely to persist in 2026. So give us some perspective, Sarah. How unusual are these divisions and why are they happening?
Yeah, so these are very unusual divisions actually for the Fed, and they're very unusual for Chair Powell, who is kind of known on Wall Street and in Washington for his ability to foster a consensus among the committee. But, over the course of the last 3 meetings, we've seen a bunch of dissents. We saw 3 of them in December, which is really, really rare. And what that stems from is kind of a muddy economic picture where policymakers are interpreting economic data in different ways. So starting last year, we saw a labor market begin to cool off while inflation was still above target, thanks in part to those tariffs. And at the same time, as Dave mentioned, growth is looking really robust, and you had equity markets that were soaring. The Fed has one big lever to control the economy, it's interest rates, and it can't impact both sides of its mandate, which is inflation and employment, at the same time. And so when you have a muddy picture, the result has been you have one group of committee members who want interest rates to be a little lower to stimulate growth, maybe some insurance against further weakening in the employment picture. And then on the other hand, you have an increasingly vocal group of members who would rather hold rates steady. They say growth is okay. They say inflation is a bigger risk, and they see improvement coming in the job market. So they want to stand pat and stay where they are. And yeah, that's the divide.
So are these divisions, are they good, are they bad, or are they kind of indifferent for the Fed and for the markets?
Yeah, that's a big it depends. It depends on how long they last, honestly, and it depends on what's driving them. The Fed makes policy decisions by committee. There are 12 voting members at any given meeting. Analysts say that kind of healthy intellectual divisions within that committee are to be expected. And that's true and that's healthy so long as they're focused on data and so long as they're focused on the economic picture that we're seeing. Of divisions kind of stemming from politics would maybe be a little more worrying. An extended division, some folks have argued, might be a little more worrying because that kind of has the ability to erode the Fed's credibility over time. But we're not there. That would be like a year or two long thing. We're not there yet.
Got it. Now, as you pointed out, the Fed is, of course, trying to manage a dual mandate of inflation and employment. So would you expect one factor to outweigh the other in 2026 and really drive policy this year?
So Powell, over the last couple of meetings, and other Fed officials have been pretty adamant that their favorite phrase, data dependent, they're going to remain focused on the data as it comes in. Powell has recently said the balance of risks is a little more even than it was, but that said, they have been focused on the labor market and have said so explicitly, over the course of the back half of 2025. Most analysts expect them to kind of keep that bias as we move forward and be more sensitive to weakness they see in jobs and ready to respond to it. The thing that could change that is improvement in the labor market. If we see things start to pick up later this year, that would really, really raise the bar for future cuts.
All right. Now, we, of course, have a new Fed chair coming in May when current Chair Powell's term expires. So are Fed watchers expecting politics to overtake policymaking here? And do you really think that the Fed's independence is at risk?
Yeah, this is certainly an unusual moment. We've had a lot of teasers. We don't have a lot of information yet. We could see the announcement any day. And then, in the background, we have kind of an ongoing Supreme Court case and other kind of political questions surrounding Fed independence that are complicating the picture. In general, on the next chair, markets are expecting someone with a kind of dovish bent, someone who is likely to support a push for lower interest rates across the board. But as I mentioned earlier, the Fed is a committee-based organization, and this is what analysts really emphasize when they talk about this. There are layers kind of checks and balances built into the Fed structure that are in place, and they prevent kind of one person, even the chair, from having sort of an outsized influence on policy decisions. And an overly partisan chair could really face a lot of pushback. And at the end of the day, they would be one voice among 12. And then the other factor at play there, the other check, is the market. You have kind of instant feedback from the market after Fed decisions. And if investors start to get worried, if they start to get anxious, you could see bond yields spike, for instance, which would be trouble for investors. And so, those are kind of the counterpoints to the Fed independence worries. It's certainly something to watch. It's certainly something to pay attention to. But in terms of the urgency, I think we're not seeing it yet.
Well, thank you so much for joining us this week, Sarah, giving us some clarity on all of it. We look forward to welcoming you back to the podcast again soon.
Can't wait. Thank you for having me.
All right, Dave, back to you. We've got a busy week of earnings ahead. We have two of the hyperscalers reporting this week, and that's Microsoft, ticker MSFT, and Meta. Of course, Meta. What's really going to matter here when it comes to the reports that we're going to be seeing from all of the hyperscalers in the next couple of weeks? And then, of course, how do all of them look from a valuation perspective as we're heading into earnings season?
Well, from a valuation perspective, Microsoft and Meta are both 4-star rated stocks. In fact, both of them are trading at a 22% discount to fair value. Although in my mind, I think they have different. In my mind, Microsoft is much more of that core holding type of stock, whereas I think Meta, at least in my mind, is much more of a bet on artificial intelligence and their CapEx spending really to build out, the AI part of their businesses. As far as earnings for this past quarter, I don't know of any reason why they shouldn't meet or beat expectations. And I don't think the market really cares that much about their earnings for this individual quarter, in and of itself. I think the focus for all of the hyperscalers is going to be on their capital expenditure projections. So I put together a chart at the end of last week because I just wanted to give people a bit of perspective on the scale of the amount of growth in those expectations for CapEx. So what I put together in this chart for each of the main hyperscalers is what our current forecast for 2026 CapEx spending is, what that forecast was in our model a year ago, and then I also show what their CapEx spending is as a percentage of revenue. So for example, if you look at Meta, we're currently projecting $78 billion increase over the course of last year as our analysts updated their models. The other thing I want to highlight is just how large of a percentage of CapEx that is as compared to sales. So we're currently modeling 33% of sales being spent on CapEx this year. It was 25% in our model a year ago, which actually was also going to be the same as the 5-year historical average for CapEx spending. Similar story for Microsoft. We're looking for $94 billion of CapEx spending this year. A year ago, we were only projecting $57 billion. We're looking at CapEx as a percentage of revenue, almost 30%. We were modeling 18% last year, which was still above the 16% average, historical rate. Lastly, for Alphabet and Amazon, again, big increases, especially at Amazon, looking for that to go from $74 billion up to $134 billion in spending on CapEx, taking their budget up to 70% of sales, up for 10%. And I think there's still a lot of upside, even to some of our own, projections here. I think consensus for Meta, for example, is $95 billion for 2026. And I think the market just generally is looking for all these CapEx spending numbers to go up even higher than what we've already projected for this year. And if we don't see that happen, I think there could be a lot of disappointment, specifically in AI stocks, many of which are getting to be overvalued and, based on our base case, have probably gotten to be too overextended. So I think you need to see that CapEx, expectations continuing to go up to support the AI story at this point in time.
All right. Well, we have several other companies reporting this week, so let's quickly run through some of them. Apple, of course, looks about fairly valued heading into earnings. So what are you going to want to hear about more during the call?
Yeah, this stock's fallen enough from its peak that it's now down in 3-star, had been a 2-star stock for quite a while. Really, what I want to hear about is how they plan on incorporating AI into their products and services, why they think that's going to be value added to users, how they're going to monetize it, and of course, their CapEx plans as well.
All right, Tesla reports this week too. How's the stock look from a valuation perspective heading into earnings?
I mean, there's a huge Elon Musk premium priced into the Tesla stock. It's a 2-star rated stock, almost a 50% premium, to our valuation based on our base case. In my mind, to justify the valuation here, Tesla really needs to show to the market, a new and expanded growth story above the current base case for electric vehicle business. So some of the things I know our analyst team is going to be listening for is for timing on rollouts for the robotaxi, full self-driving. And I think a lot more focus now on the robotics division as far as like when you might see commercialization of Optimus.
Now, ServiceNow, which is ticker NOW, has really struggled. Stock's pretty deeply undervalued from Morningstar's perspective. And in fact, we got a question that came into our inbox over the weekend about it. So do you think ServiceNow maybe is one to consider buying ahead of earnings? Could something maybe come out of the report that would boost the stock?
Yeah, we shall see. I mean, no one's really cared about earnings and, guidance on this stock. I mean, they've been beating for, multiple quarters in a row. And as you noted, that stock just continues to keep sliding. It's currently at a 40% discount to 4-star rated stock. I think it's just overall the market is still just more concerned about how artificial intelligence could potentially displace their business as opposed to how artificial intelligence can help them improve their products and services, make them more economic value added, for their clients. I think it's just a matter of, management needs to be able to convince the market of this. And I think when they do, there's a lot of upside here. But until then, I think the stock will continue to keep stagnating.
All right, we have ASML reporting this week, and the stock's up already nearly 30% in 2026, and it looks about fairly valued according to Morningstar. So what are you going to be watching for here?
Well, what happened was TSM, Taiwan Sun, their numbers are very strong. They increased all of their CapEx spending guidance, which of course then boosted our fair value on ASML by 18%. It's a 3-star rated stock. I mean, we're already at this point pricing in 2027 and 2028 being very strong years for semi-equipment manufacturers. So I think for any additional upside from here, we need to hear if there's going to be other customers like Intel maybe ramping up their foundry business, but would need some sort of new growth story here to push this one up even further than it's already moved.
Now, UPS's stock has revived a bit since the company last reported earnings. And in fact, now the stock looks fairly valued. So what are you going to be listening for in this week's update?
From an economic point of view, I just want to hear how the kind of fundamental business is going from that volume perspective. But for the company perspective, for the stock, in and of itself, really looking for operating margin improvement. Also want to listen for any potential discussion of their dividend. As we've noted before, our analyst has highlighted that dividend could be at risk this year. He doesn't think they're going to cut it, but based on the amount of free cash flow that we're looking at, there is certainly that potential.
All right, now a recent pick of yours, Colgate-Palmolive, which is ticker CL, also reports this week. So do you still like it heading into earnings?
I do and I don't. I mean, from a valuation perspective, it's up almost 13% since we highlighted it on the January 5th morning filter. So it's a 3-star stock. It's only at a couple percent discount from fair value. For here, I'm just looking for a return to growth in organic sales, looking for a good mix of volume increases and pricing increases. I'd like to see a rebound in margins. So if we could get all of that and that helps improve, the intrinsic value, then it might be, a buy again. But at this point, more of a hold.
All right, well, let's pivot over to some new research from Morningstar. We'll start with takeaways from the earnings reports from the Megabanks. What stood out to you, Dave?
When you think about the megabanks and really all the banking sector overall, everything that can go right for a bank is going right for a bank right now. You have the steepening yield curve that's increasing net interest income margins. The economy is keeping bankruptcies and defaults, on the lower side, so charge-offs are relatively low. With the stock market, at its highs, you have very high fees for assets under management, investment banking, trading, both doing fine. Looking for a rebound in mergers and acquisitions this year, so that's going to help bolster them from a fee income perspective as well. Following the results, I know our team made a couple of fair value increases here and there, but overall, I'd say stocks are pretty fully valued at this point in time, based on our outlook.
All right, last week we saw Intel's stock, and this is ticker INTC, was down 17% on disappointing guidance. But Morningstar raised its fair value on the stock by $4 to $32. So any opportunity with Intel today?
I don't think so. It's a 2-star rated stock, still at a 40% premium to fair value, and that's even after the stock had already sold off. In my mind, when I look at the chart and look at how much it had ramped up over the past couple months, I think it's gotten caught up in the AI build-out boom, but I don't look at this company as really being a participant of the AI build-out boom. Looking at their numbers here, fourth quarter revenue came in at $13.7 billion. That was flat sequentially on a quarter-over-quarter basis, down 4% year over year. Their first quarter revenue guidance at $12.2 billion at the midpoint, that would be down 11% sequentially and certainly worse than what we expected.
Now, Netflix stock, which is NFLX, slipped after earnings. What did Morningstar think of this report?
So results all look pretty good. I mean, 17% revenue growth, the operating margin expanded by 3 points. But overall, when we look at this stock, we think the market has just over extrapolated the growth that we've seen over the past couple quarters way too far into the future. If you look at guidance for 2026, they're looking for organic sales growth of 11 to 13%, so much lower than what they saw last quarter. They are still looking for more margin expansion of 2 points. Overall, that puts it in line with our estimates, but certainly below what the street was looking for. As you noted, the stock sold off. In fact, I think the stock's down almost 40% from where it's peaked. So it was a 1-star stock in mid-2025. At this point, with as much as it's fallen, it's now a 3-star rated stock.
Now, Dave, you mentioned Taiwan Semiconductor earlier, and this is ticker TSM. Put up really solid numbers, great guidance. And Morningstar really raised its fair value estimate on the ADRs all the way up to $428 from $310. So walk us through that big fair value increase and tell us whether the stock is now a buy.
Yeah, I think solid is going to be the underestimation of the day here, Susan. I mean, just very positive indications for artificial intelligence spending in 2026. Their 2026 revenue guidance is up 30%. They also provided much better, long-term guidance through 2029. So with that longer-term guidance, that was really what caused us to raise our multi-year forecast, resulting in the increase in our fair value today. Their CapEx guidance for this year is between 52 and 56 billion. We were looking for only 47 billion before that. And of course, that's very positive for all of the wafer fab equipment manufacturers, companies like ASML, which we did increase our fair value after the report. Lam Research is another one that will be a beneficiary of this. To me, it just shows just the sheer amount of demand in order to manufacture semis, specifically the AI semis. Now, the interesting thing here that our analyst has pointed out is, in his mind, management is usually known for being pretty conservative, in the guidance that they provide. So in my mind, there's probably even more upside than what they've indicated here. So the question is the stock a buy? It's a 4-star rated stock at a 24% discount. This one's been a pick several times on the morning filter over the past few years. The pattern that we've seen here is that we've noted that it's been undervalued. We saw the market, catch up to where our fair values are, and then the company comes out with, earnings and guidance like this. We then put that into our model, raise our fair value to incorporate those new growth dynamics, and still look for, further growth ahead yet in this company.
All right, so at 4 stars, sounds like a buy. All right, now one of your former picks, Kraft Heinz, which is, of course, KHC, was in the news last week because a new filing from Berkshire Hathaway suggested that the firm would be selling its position in the stock. So what Morningstar make of that news?
Well, I mean, first of all, they're selling. So I think what you need to do is, take what I say with a grain of salt. Warren Buffett, certainly one of the greatest investors ever, one of the richest men in the world. I'm not. So like I said, take this with what you. I think there's really two aspects to consider with what's going on here. So the first is going to be valuation. And the second is, technically, what is that going to do to the stock and how it's going to trade? So from a valuation perspective, we didn't make any change to our intrinsic value. It's still a 5-star rated stock, trades at over a 50% discount to our long-term intrinsic valuation. In perspective, the company's trading at 8 times, trailing earnings, trades at like 10.2 times, enterprise value to EBITDA. So pretty low multiples as far as that goes. Now, as far as the technical implications on the stock, they're selling over 0.25% of the company's stock outstanding. So it's really going to depend on how fast do they want to liquidate this position, how much do they care about the price that they're going to get versus, how quickly do they just want to get out of this name. So I think this is one where Greg Abel, he just may want to get out of this loser overall. I mean, the stock has had a long-term downward trend. It just might be a case of, portfolio manager exhaustion where he's just telling his trading desk, just get me out. I just don't want to be in this one anymore. So there's definitely going to be an overhang on the stock until that position is liquidated. I mean, from a trading point of view, if you're a trader, why would you buy this? Why would you bid when you know that as soon as you buy some, there's going to be more coming out right behind it? So I think a lot of people are going to take the perspective of sitting back and letting the stock, come to them until we find out that they're done selling whatever it is that they're going to sell. And once that happens, I think it should be very well positioned, but it's definitely going to be an overhang on how this stock trades for months, if not quarters to come.
All right. Well, our question of the week from a viewer named Steve is also about Kraft Heinz. Steve wants to know whether the company is a worthwhile long-term holding or is it a value trap, specifically for someone who's looking for good dividends for the long haul. So what say you, Dave?
So I specifically reached out to Erin Lash with this question in order to get, her response. And, in her mind, not a value trap. The company has a portfolio of brands. They lead within the categories, that they compete. The company's focus on innovation has profitably improved sales, over time. Some specific examples, that she gave were improvements on like the mac and cheese business, the spreads business, things like Capri Sun and Lunchables, have all done very well. Overall, the company maintains a very healthy balance sheet, and it's one with, as you noted, you get a very high dividend yield. So it's a stock where you get paid to wait until the market realizes, the value that's here. Now, as far as whether or not it's a value trap, I'm just going to run through our model and our forecast, and investors can make up their own mind. So from a revenue perspective, we're only looking for 1.3% top line growth here in 2026. Averages 2.5% growth from 2027 to 2029. So I'd say less than inflation growth this year, kind of inflationary growth the next 3 years thereafter. From an operating margin, in 2025, looks like the company is going to come in at 19.2%. That's very low. I mean, the company only ever printed lower operating margins in 2022 and 2014, and there were specific catalysts which caused them to have low operating margins those years. If I go back over, a further or longer time history, over the past 10 years, that operating margin has averaged 21.9%. It has been low, only 20% for the past 3 years, which has brought that long-term average down. We're forecasting 19.7% in 2026 and averaging 20.4% in 2027 to 2029. So we're not looking for any big heroic increase in sales, not looking for any J curve in operating margins. Really, it's just much more of an ongoing normalization story. From an earnings point of view, we're looking for $2.51 for 2025. Looking for that to increase steadily through 2029, getting up to $3.57. So essentially a 9% compound annual growth rate. Looking at the company stock trading at 9 times 2025 earnings, 8 times our 2026 earnings estimate. So if you think this is a value trap, in my mind, that means that you need to expect that not only is the company not going to grow from a revenue perspective, but you also then have to assume that operating margins are not going to normalize, that they're going to stay, at these low levels, for years to come. So I think it's one of those ones where you have to have your own view, but just any kind of normalization here makes this stock look very attractive to us.
Well, Steve, thank you for your question. As a reminder to our audience, keep sending us those questions. You can reach us via email at themorningfilter@morningstar.com. All right, let's get to the picks portion of the podcast. And this week, we're revisiting the first 3 stock picks Dave ever made on the Morning Filter and talking about which of them are still attractive buys today. All right, those first 3 stock picks were Berkshire Hathaway, Amazon, and Tesla. So Dave, walk us through how those stocks have done since you first recommended them 3 years ago.
Sure. So Berkshire, let's start with that one. That's been a laggard. It's up 55% versus, depending on how you want to define the market, but I use, SPYs here. So against, the S&P 500, that's up 74% over that same time period. In my mind, I still think that's actually a pretty good, strong return. The reason being, of course, that, the S&P 500 has had very strong returns because of just how much AI stocks have outperformed over the past couple of years. If we were to pull those AI returns out, it'd be much closer towards, what Berkshire has done. Amazon up 145%. I mean, that's close to double the market return. That's done very well. But really, Tesla up 238%, over 3 times the market return. So certainly a good call by our analyst team, 3 years ago. Having said that, it's got that huge Elon Musk premium in it. So really got to be a believer in Elon to be paying, those kind of multiples today.
All right, so let's go through these 3 stocks one by one and figure out which ones you still like today as picks. We'll start with Berkshire Hathaway. So give us the highlights.
So Berkshire Hathaway is trading at a 6% discount to fair value. It's a 3-star rated stock. And of course, it does not pay a dividend at this point in time. We rate it with a wide economic moat, that economic moat being based on its cost advantages and intangible assets.
Now, Berkshire looks, pretty close to fair value today. And we had Warren Buffett officially step down as CEO at the end of last year. And of course, there's some questions about what'll be next for Berkshire with new CEO Greg Abel running things day to day. We've already seen this Kraft Heinz issue. So given all of that change, do you still think Berkshire's a buy today?
I do. And when I look at Berkshire, I kind of almost look at it as more like an actively managed ETF. but one that has a very high exposure to private equity, which you can't necessarily get investing, in a lot of other ways. So I really like that PE exposure, and I think that's a good way to get that exposure, for your portfolio. So technically, yes, it is a 3-star rated stock, which means that it's, within the range we consider to be fairly valued. I just note that it's really close to being that 4-star range. And in fact, I think if it stays here, it probably moves in there. We do have a little bit of a band, when it moves from one, to the other, from 3 to 4. And yes, I would certainly prefer to buy it at a greater margin of safety. So I think in this case, if this isn't a stock that you don't own, it's something that fits within, your own portfolio dynamics, I would certainly be willing to start, a partial position here and then leave some dry powder to be able to dollar cost average down, if that stock does sell off.
All right, move on to Amazon. Dave, walk us through the numbers.
Sure. Amazon is a 3-star rated stock, currently at an 8% discount to our long-term intrinsic valuation. Another one that doesn't currently pay a dividend. We rate the company with a medium uncertainty and a wide economic moat. And it's a very wide economic moat. It's actually one of only 2 stocks that have 4 of the 5 moat sources, those being cost advantages, intangible assets, network effect, and switching costs.
Now, Amazon looks, close to fairly valued as well. So would you say this one's a buy or a hold at today's price?
Well, based on where it's trading, it's right at that border between 3 and 4 stars. So yes, I would certainly prefer a greater margin of safety. But similar to Berkshire, I think now you could probably go ahead and buy some if it fits within your portfolio dynamics. Again, leave that dry powder so you could dollar cost average down if the stock sells off. But overall, the company's still hitting on all cylinders. You have a lot of upside from AWS. That's its AI hosting platform. I think there's a lot of upside here if they can continue to keep getting retail margins, moving higher and improve over time. And of course, we've talked about before how we think the advertising business they have, is very valuable as well. So yeah, I think this is one, even at that 3-star range, you can start a partial position and dollar cost average in, to the downside.
All right. Now, Tesla, as you mentioned earlier, a couple times, is very overvalued today. So of course, it's not a pick any longer, but you brought us a swap pick this week, and it's Palo Alto Networks. So run through the key metrics on it.
Sure. So it's a 4-star rated stock trading at a 19% discount. Again, one that still doesn't pay a dividend. But the reason is that they've been reinvesting their free cash flow on organic growth and roll-up acquisitions. So this is a case where, I'm not too concerned about them not paying a dividend. Now, it is in the tech sector, so we rate it with a high uncertainty, but it does have a wide economic moat based on its network effect and switching costs.
Now, we've talked about Palo Alto several times on the podcast because it's from one of your favorite industries, which is cybersecurity. So why do you think it's a good swap for Tesla today?
Well, and I have to admit, it's not necessarily really a swap per se, for Tesla. Now, of course, I certainly wouldn't bet against Elon. I wouldn't take the risk, shorting that stock. Palo Alto is going to have very different risk reward, profile. It's just that with Tesla being overvalued here based on our base case, I was looking for something that's going to be in that large cap growth stock category. And admittedly, it's very hard to find undervalued large cap growth stocks, today. There's a couple of others that are undervalued, but this is the one that I'm, the biggest fan of today. As you've noted, I've long been a fan of investing in the cybersecurity industry. It's an industry where overall spending on cybersecurity is a low percentage of the overall IT budget for companies, but companies have to stay at the forefront of cyber protection. It's not an area, that they can cut costs or scrimp on. It's just too huge of a negative impact, to a company if it suffers from a cybersecurity attack, both in terms of direct costs just to be able to mitigate and, be able to fix those kind of cybersecurity attacks, but also just huge reputational costs if you suffer from a cyber attack. Now, in this case, the stock has pulled back. I think it's down about 18% off its highs, which in my mind, I think that provides kind of the opportunity to be able to start a position in this one where you are buying it at a pretty good margin of safety below its intrinsic valuation.
All right. Well, thank you for your time this week, Dave. Viewers and listeners who'd like more information about any of the stocks Dave talked about today can visit Morningstar.com for more details. We hope you'll join us next Monday for the Morning Filter podcast at 9 a.m. Eastern, 8 a.m. Central. In the meantime, please like this episode and subscribe. And go Miami University basketball. Dave's an alum. Have a great week.